Good afternoon, good morning. I'm Dr. Renee Friedman. I'm editor-in-chief here at EXANTE, and today I'm going to discuss basically a review of earnings, elections, and other factors moving global and Asian markets. Let me share my presentation with you. Just one moment, please. Right. So today I'll be discussing the present state of the global economy, the growth forecasts, both globally and for Asia, what's been happening in bond markets, equity markets, currency markets, and of course, geopolitical risk and the potential impacts that can have particularly on major Asian economies. Okay, in terms of the global economy, we have to start off at the world's biggest player, which is the US. The Fed has kept rates at 5.25. It hasn't cut rates. We are looking, however, at some of the conditions for the Fed to cut rates starting to emerging as they happen over the past few months. We have inflation continuing to fall. The labor market is softening. We have unemployment is now currently at 4.1%. It's been at 3.9%, so it is edging upwards. Job openings have fallen from about 12 million in March of 2022 to about 8 million in May of this year. We also see the general, economic growth is slowing as well. Although business activity levels are still remaining quite high with the composite PMI, S&P composite PMI coming through yesterday. It's still in positive territory, coming in at 55, up from 54.8. Anything over 50 is considered positive growth. And the Fed has been holding off. We do have some key data coming through this week. Later today, we will have GDP for June GDP estimates coming through. Tomorrow, we will also have the PCE indicator, which is a critical indicator that the Fed looks at. And we are expecting that to be at about 0.1%, indicating that inflation, particularly core inflation, is starting to come down. That's what the Fed is most worried about. We've had a problem of very high services inflation, very sticky wage inflation. It's still, well above where it needs to be. That's why it's important to see that labor market softening. But we don't want it, the Fed does not want it softening too quickly, and I'll get into that in a moment. So the other things that we're also seeing in the US economy is, of course, what's happening in the equities market. Q1, great levels of return for Q1. So expectations are really quite high for Q2. However, thus far, we've had tech disappointing. We've had as of yesterday, tech markets, US markets overall, suffered their worst day since 2022. We've had NVIDIA falling, which has been the massive leader coming forward over the past 6, 7, 9 months, coming through massive growth last year and this year. That fell. We've had Tesla falling, of course, coming through down over 12%. We've seen this rotation over the past few weeks to the smaller size companies, small caps and mid caps, as the expectations of that interest rate cut accelerate. And that actually is not expected given where we are in the rate cycle itself. We are looking at the Fed pivoting. It's a soft landing trade. We are looking at the Fed pivoting to cutting rates. So it's not a surprise that there's now renewed interest in other sectors that are more interest rate sensitive, particularly those, as I said, the small and mid cap stocks. Okay, that's overall for the US, and we'll get to more details on certain things there. In terms of Japan, we've seen a lot of issues with the yen over the past few months. The Nikkei has been going quite strongly, Japanese equity markets. The issue has really been what's going on with the yen. We've seen a lot of interventions coming through. Inflation has been well up above the bank's 2% target for over 2 years. It's at 2.6% in June. It's been at that, it's been well over, but the Bank of Japan has been very, very cautious. We did see some change in March. There is increasing expectations on whether or not on the Bank of Japan cutting rates, raising rates next week. For them, they've really been waiting on whether consumption will recover and whether they will keep at that 2% target. Because remember, for decades, it couldn't quite reach that. It could not reach that target. The Bank of Japan is all meeting the same time as the Fed next week. So we'll have both the results of those on the 31st of July. The one thing we are likely to see is that there is likely to see an agreement on the time frame for the tapering of the bond market. They need to shrink their $5 trillion balance sheet, and we're looking for that to happen to begin in terms of their taper over the next 1 to 2 years coming through. In terms of the economy itself, the Japanese economy is in expansionary territory. We saw it in terms of the latest flash composite PMI. It's up at 52.6% in July, up from 49.7 in June. Service sectors are being really solid. So Japan is looking at growing, despite the fact we have all the demographic risks, et cetera. We have the high debt levels, et cetera, but most of that debt is owned by Japanese themselves. So not as much of an issue as debt is in the US and in other countries. The big issue is what's going on with that currency, and a lot of that has to do with that interaction with the US Fed, and I'll get to that more in a moment. In terms of China, we've seen growth slowing. It's at 4.7% thus far, what we're seeing. We're looking at actually further growth is going to be slowing actually quite a bit over the next decade. And that's due to a lot of the structural issues. A lot of that's due with demographic challenges in China. It has a lot to do with issues of capital debt ratios, and as well as productivity issues within that. Also in China, of course, we have the ongoing story of weak domestic demand, resulting in inflation, essentially. We're seeing prices dropping quite considerably. We have the problem, of course, the ongoing problem with the property market, despite the fact that the central bank, as of yet this morning, actually surprise rate cut again, is causing considerable problems for the government. And in fact, we had last week the ending of the third plenary meeting, and that was really in many ways a disappointment. It really didn't deliver much. A lot of the same accolades said, there really wasn't much given to the private sector as much as that needs to be in terms of R&D support and things of that nature. There's a lot of discussion around STEMs and increasing education in STEMs, which are science, technology, engineering, that level of things. The main issue is that it's still going to be very protectionist in many ways. It's going to be very much focused on security issues as well. At the moment, so what we're seeing, given this weak domestic demand in China, the problems with the property market, exports are increasing, which is a good thing, but then it's going to be coming up against trade barriers a little bit. I'll get to more of that in a moment. As a result of this, we've seen the won. It's now came through yesterday an 8-month low. We do see the People's Bank of China allowing limited depreciation. To date, the won is about 2.5%, 2.4% weaker versus the dollar. We did see, of course, the central bank reduce a 7-day reverse repo rate. 1-year loan prime was adjusted, and it cut its rate on its medium-term lending facility from 2.5 to 2.3%, which is the first cut since last August. It is also trying to inject liquidity into the market. It injected about 26.5 billion of liquidity into the market. That was today. So they're very aware that this is a problem. This is also reflected in the Chinese bond market. They're trying to put a floor on the bond market coming through, particularly in relation to longer term bonds, which is again related to that debt issue for them. In Hong Kong, we've had GDP growth coming in at 2.7% in Q1. We have seen an improvement coming through on tourist numbers, mainly from the mainland, so it's 70% pre-COVID levels. Export of services remained as an important driver of growth coming through. Imports rose 3.2%, exports at 6.7%. Inflation is creeping up in Hong Kong. But for Hong Kong, it's an issue of battling high interest rates. It's a very complex geopolitical environment, and there is that large budget deficit issue for Hong Kong as well. In India, I'm only going to cover these four economies today. India has again kept the repo rate, central bank rate at 6.5%. Its RBI is still looking to curb inflationary pressures. We've had annual retail inflation coming in at 5.08%. It's up from May. We have high food inflation coming through. It's hitting 9.36% in June. The budget, which was proposed earlier this week, passed through, I think. It has obviously affected the equity market because it raised the tax on stocks held for less than 1 year to 20% from 15%, which was effective immediately, and from 12.5% to 12.5% from 10% for those who held their stocks for 1 year. So we've had some interesting things happening on impact on the equities market there. The equities market itself within India is growing quite substantially, and then I'll discuss more about the India versus China trade in a moment. India, is still growing quite quickly, hence the issue as well of inflation. Its composite PMI rose to 61.4 in July from 60.9 in June, its highest reading since April. So it's had accelerated growth in both manufacturing and services. People tend to think of India as just an IT service center. It's growing itself domestically. It's growing because the middle class within India itself is growing. So we're seeing both domestic demand growing and foreign demand growing for Indian services and goods. In terms of the global growth forecast, the latest coming through is from the IMF. They've revised growth a little bit. Global growth is looking at 3.2% in this year, 3.3% in 2025. Asia is expected to continue to account for the bulk of the growth over the 24-25 period. In the US, they've actually revised the growth slightly downwards to 2.6%. In China, again, growth at 5% expected for, again, that slowdown into 2025. And I see this slowing even further as we get through the 2020s. Hong Kong growth is expected again in that 2.5% to 3.5% range. It will be limited. We have that budget deficit worries coming through. We have obviously what's happening in China. There are implications for Hong Kong markets on that. Japan at 0.7%, 1% 2025. And India 7.3% this year, 6.5% in 2025. So a slight slowdown coming through in India. Right. One of the things I want to talk about a little bit is what's been happening in terms of bond yields and level of performance. We've had the US performing since the level of performance over roughly year on year, over a year, 4.2. You can see the graph here. China's not done much. India's been flat for quite a considerable period of time. Still great performance, but again, we've not seen that change in rate for a considerable period of time, and the US has been a bit more volatile coming through. In terms of the benchmark bonds coming through, this is a year-to-date performance change on here. So again, you can see a lot of volatility coming out of the US in particular on this. And Japan's been an interesting move around, and what we see here is really that reflection of what's started to happen as we're expecting the Bank of Japan to start to raise rates. In terms of currency performance, Well, you can pretty much see what's going on with Japan here. It's not been a particularly good picture. The dollar has been incredibly strong this year. It is continuing to strengthen. We are expecting some, it's been very volatile. It's been weakening a little bit now over the past month or so, and then we're starting to see it uptick a little bit, and that's more due to the political risk situation, which I'll get to in a moment. In terms of the Hong Kong dollar, pretty steady because again, that's pegged to the dollar. US dollar, rupee, again, level of performance, pretty solid coming through because we haven't seen, even though it's on great growth, we haven't seen any change in central bank policy or hint of that happening. Right, so with the US dollar, the strength is continuing. We are looking at potentially a rate cut in September. That's, as I said, all eyes will be on GDP later today and PCE this Friday for that September call. We are looking at, if it doesn't cut in September, it will probably be November, and we might even have another second in December. The big issue, as I said, is that core inflation number. We are actually looking at sharper easing next year. Relative to this year. We are looking at several more cuts next year coming through. And a lot of that has to do with the slowdown that we're seeing within the US. If we see, and the Fed has expected the slowdown to happen. Markets are currently reacting to the fact that the Fed is going to cut because of inflation is coming down. However, if the Fed starts to feel the need to cut because we see the labor market dropping too quickly, we start to see layoffs increasing quite dramatically in the fall, that will actually get the market quite nervous, and it will affect the various sectors of the equities market in particular. So if that were the case, then you'll start to see more defensive stocks probably rising as a result of that. At the moment, of course, obviously I'll get into the tech situation in a moment, but at the moment, we are seeing that rotation outward, that breadth, that widening of the market into the small and mid caps and those rate sensitive stocks, which are quite broad. I mean, prior to this, it wasn't just tech that performed well. It was the banking sector performed well. As we see rates cut, banking sector will start to go down. Those types of things will start to happen. For the yen, as I said, the Bank of Japan has spent, we estimate, around nearly 6 trillion yen in July supporting the yen. That's the numbers that everyone's talking about coming out. We've heard a lot of discussion about normalization coming through. We've seen a lot of pressure being put on the Bank of Japan to start to normalize, to start to hike rates a little bit. Again, there's still going to be a huge divergence between Fed and Bank of Japan rates. Even if they cut rates. However, if the Fed does begin their rate cutting cycle, roughly the same time as the Bank of Japan, even happens September, even a little later, and Japan stops their monthly bond purchases, or it starts in terms of reduces them. They won't necessarily stop, obviously, but in terms of reducing those purchases, we will start to see, there is an expectation that we will see the dollar versus the yen, I should say, will appreciate. We might see it, it's currently at very high levels. It's been at over 160, it's now below that, it's 155. We may see that drop to the 140s if we start to see that happening, mid 140s. For the won, we see lower interest rates and ongoing economic problems, leading to further depreciation of the won. The government is being very, very careful about this, though, because obviously that would lead to massive outflows potentially on the overseas won. On the Indian rupee, we have seen it hit its lowest level against the dollar this month, and that's due to the sentiment on local equities, due to that new budget happening. Again, given the high rate of inflation, they still have not been able to contain that because it's growth driven, as well as these issues around local equities. We've seen a lot of investment through private investment funds going into these equities. We're going to see a little bit of volatility, most likely, around the Indian rupee moving forward. And it's kind of a little difficult to say if the market will proceed, because it is growing so quickly, if the market will just say, yes, this is a good thing, it's growing quickly. the rates are high, let's pile in, because there are those concerns around what's happening in equity markets, although we are seeing inflows of FDI. So it does seem to suggest that the rupee might be appreciating. In terms of year-to-date performance thus far, as you can see here, we've had S&P, we had a massive downflow yesterday, so this kind of reflects what's been happening in terms of that rotation move. And as we see what's happening in July, a little bit over as the AI shine comes off a bit. But the S&P is still up almost 14% this year, which is not bad at all. The Nikkei is up 17%. It's been an undervalued market in many ways. And it really starts to see some of that reflection, that movements around March, which is what's going on with the central bank that was perceived as positive. We've had some growing demand. We obviously saw a big jump up in May to June. Now there's a little bit of level of uncertainty happening in the Nikkei coming through. In terms of the Hang Seng, again, we saw some positive reactions in May. We had the government budgets changing. Whoops, my apologies here. Sorry, this is. And in India, again, a lot of spiking coming through, some changes. We've had a lot of growth happening in India. And what is happening in terms of level of performance has been great, but now we have those concerns with those new budget taxes bring. So overall, sorry, I'm trying to move my slide away so I can actually see what I'm reading. The Q2 is generally strong reporting, even though we're still in corporate earnings season in the US. According to LSEG data, the 133 companies in the S&P that reported earnings to date, almost 80%, 79% are reporting above expectations. That's above the long-term average of 66%. In June, US equities were higher. We look going back just last month. They logged their 5th monthly gains. We've been getting record gains all over June. And I think now that the bar was set so high that the market is reacting very much as a result. Obviously, we have the news from Tesla. As I said, yesterday we saw the S&P falling 2.3%, which was its worst day since December 2022. The NASDAQ composite fell 3.6%, its worst day since October 2022. But again, we're still waiting for NVIDIA to report, which won't happen to the latter part of August. Microsoft, Apple to report as well, and they'll be reporting next week coming through. We had Tesla, of course, falling over 12% yesterday, and it fell the day before in terms of its reports. And I think coming through on this is really AI is still going to remain a strong theme. I don't think that's gone off completely. And I think when we see the numbers coming through, I think it's just that the expectations might have been a bit too high. We're going to see some shift in valuations potentially as a result. It does obviously feed the concerns that the broader market, related to the fact that the broader market has been far too reliant on the Magnificent Seven. Risk sentiment at present is still kind of fragile, but we are pretty much still in a risk-on environment. So I don't think we should get too negative too quickly. I think what we do see is that despite this temporary slide in Facebook, which I think Meta was down, 5.5%, Microsoft down 3.5%, just thinking about yesterday, Apple about 3%. There's still, these companies are still going to be spending a lot on AI. AI is still growing. Remember, these companies, a lot of people compare them to what's happening, dot-com boom 20 years ago. Very, very different scenario, and I've said this before. Just because they're not exceeding those earnings expectations, we're seeing that profit taking happening, but it does not mean that these companies will not continue to grow. It just means as long as we do have these expectations of the Fed cutting, that we will see the broadening of the market. Right. Oops. We'll go back up. Hong Kong, it's been obviously down. China markets have been down following the April-May rally. India, as said, it reached an all-time high actually right before the budget was announced on 22nd of June. It's been driven by strong flows from foreign institutional investors, strong corporate earnings. As I said, we've seen a lot of growth happening in India, positive economic data. India is now just under a fifth of the MSCI Emerging Markets Index. And in fact, there's a potential when that index is rebalanced that it's kicking out a lot of the Chinese companies. So it could actually become it's becoming more of a trade potentially than China. Indian stocks are trading at 24 times their expected earnings next year already. So there are a lot of high expectations about Indian equity markets. In terms of Japan, we've had strong Q1 with positive earnings growth. Weak yen, of course, tending to support export heavyweights within the Japanese market. We've seen total returns of 41% in local currency and 24% in dollar terms. It outperformed most markets, obviously outperformed the US. Japan has been on up because of that depreciating yen. It is well positioned to benefit from AI, building on its expertise in machinery and electronics manufacturing. So it's actually working quite well. And again, Japan, even when I'll get to the tariff story in a moment, is a US ally. So I'm not as worried about that there. I think there's a lot that's going to be continuing to happen in Japan. Right. Just keeping an eye on the time. Geopolitical and other risks. Okay, this isn't one I know a lot of people are getting very, very worried about because it kind of threw it into the mix. Trump versus Harris. Well, Kamala Harris has secured pretty much secured the nomination for the Democratic Party. In fact, they are looking at speeding up her actual ascendancy to it to 1st of August, as opposed to, and her bringing in a VP, announcing the VP on 7th of August. And a lot of the question is, if this is the case, if she does get this through, can she get elected? Two, what will be the difference in potential policy between Trump and Harris? Well, we know with Trump, taking a look at what he did in his first term and a lot of what he's talking about now, I mean, even as a candidate, he can move markets, giving a reference to NATO and his comments around that. We know with Trump, we're likely to see more tariffs happening, which will negatively impact, obviously, China. It could halve Chinese exports potentially, or Chinese growth at least, not their exports, because they wider area beyond the US, although the US is a critically important trading partner. We are going to be looking at greater protectionism under a second Trump presidency, if that happens. We'll also be looking at higher debt. Remember the tax cuts that he brought in 2017? Well, those were due to expire next year. He'll probably continue those, and that has resulted in a higher debt profile for the US. The US has to issue more debt. We're also looking at higher inflation. Trump wants a weaker dollar. Trump also, because Fed Chair Jerome Powell term would expire during his presidency, he's not particularly happy with how Powell, who he put in place, has been performing. He doesn't feel that he's been tough enough in many ways. He wants Powell to cut. He wants the dollar. Trump wants a dollar a bit weaker. He wants the US to be exporting, but at the same time protecting its own industries. All of those things, actually, if we look at the higher debt levels, which leads to higher request for higher yields will be required. And that higher inflation, if we have higher tariffs domestically, it's actually going to have a negative impact on the Fed's ability to cut rates. All of that, of course, will have a negative impact if that happens, and we lead it through a negative impact on emerging markets and markets with close economic relations with China will also be vulnerable, not just emerging markets, but in general, if we see those higher tariffs. Because of course, as we've seen tariffs come in, particularly related to electric vehicles, related to steel, related to critical minerals that are used for the green infrastructure revolution, part of the bill that Biden put through last year. And of course, in the CHIPS Act last year, so we have the IRA, the CHIPS Act, neither of those will be fully repealed under Trump, except questions of some of the subsidies coming through. And we'll also see subsidies to green industries, I might add, and some of the protections around environmental issues in the US and how companies operate. We would also potentially see coming through under Trump not just those things happening, but it would also likely lead to further difficulties, obviously within Europe as well. So it's a good game domestically, but not internationally. However, now someone says, well, Harris gets in. What would potentially Harris if she gets in? Well, it's basically a continuation of Biden's policies. We have to remember Biden did not remove the tariffs that Trump put in place on certain sectors. And in fact, he extended them, particularly on Chinese goods. We've seen that in electric vehicles. We've seen that in solar panels, things of that nature coming through. We don't have anything really in place. Harris hasn't really gone on to talk about her economic platform coming through. But we have to remember, under Biden, we've seen an economy that's grown quite significantly. We've seen inflation coming down. We've seen fiscally expansive, hence the increased debt levels. But that was actually rather supportive to growth in terms of that balance. So the big risks, one of the big risks that we see coming through are obviously in terms of global growth and particularly US growth. We know a slowdown is on the cards. We see consumer spending growth slowing in the US. We have diminished excess savings, plateauing wages. We do have low savings rates. There's obviously less pent-up demand. We're seeing some changes in the housing market in the US as well. At the moment, tight labor markets, 4.1%, people keep saying, and I said this, we are seeing the loosening of the labor market, but it's still pretty tight. 4.1% is, relative to what we had pre-COVID. So those still continue to support employment and therefore income levels. But we are seeing that labor demand softening, so that will reduce hiring over time and wage growth compression. The issue again is if slowdown goes too far and demand for labor keeps weakening, we start to see more layoffs and we'll see more rapid increase in the unemployment rate. As I said, the big concern is that the Fed will then act out of fear to try to revive the economy, and markets won't react well to that, both bond markets and equity markets. Oops, I don't know what's going on here. Okay, let me just go back down. For China, exports are increasing, as I said. It still has a very strong supply chain, transport infrastructure, government support, despite rising global competition. And of course, in terms of trade, China's own trade restrictions have also raised concerns. So we also have to forget this is a two-sided issue when it comes to potential trade wars moving forward. There have been clashes and there will be increasing clashes, particularly if Trump gets into office, but even under Harris administration with the US and Europe on that issue of industrial overcapacity and widening trade imbalances. All of that is due to those fears by the US and by European countries that they're displacing domestic industries and jobs. And the issues of, we're going to see tariffs again continuing on electric vehicles, on solar panels, and other renewable energy infrastructure, as well as potentially on low value retail goods. And that's particularly in emerging markets, less so in Europe and the US. Obviously, of course, for China, a Trump presidency is expected to be more acrimonious. I said the higher tariffs, the hit to steel, the renewables. However, in the short term, once we know what's happening after the 5th of November, who the next president will be, if it is Trump, well, then we might see, oddly enough, a bit of a boost to China's exports in terms of that front loading, trying to get those exports out the door before he actually comes into office on the 20th of January and can put in a lot of very negative or attempt to put in a lot of very potentially negative things for China. The other risk for China is, of course, is if US interest rates remain higher for longer. The longer, then you're going to have continued downward pressure on the renminbi. On the one, you're going to have that continued downward pressure. And in the US, although we're expecting potentially, markets are pretty much pricing in that first rate cut in September, there may then be a hold a little bit. So we're not guaranteed 2 cuts this year in the US. A lot depends on what we're seeing. We've seen the labor market fluctuating a little bit. And a lot of what happens if we have a surprise on that PCE number on Friday, that will change a lot. We'll see a very strong market reaction to that. For Hong Kong, weak good and service trade is limiting the overall growth potential. As we know, property weakness is still an issue. And of course, we have the wider geopolitical risk issues very closely associated with China. In Japan, the Bank of Japan could move this month, we'll see next week. But because we have these rising geopolitical risks in terms of what's been happening in the US, that may actually incentivize some caution by the Bank of Japan. We are likely to continue to see intervention happening on the yen to support the yen. And the other big risk, of course, for Japan is that liberal democratic leadership election in September. In terms of the policy continuity, if the prime minister is unable to secure another term. In India, well, we've already had obviously the elections came through. We know Modi won. He won 292 seats. However, the Congress got 234, so he didn't do as well as he had hoped. The budget is widely expected to boost tax collection and use a record 25 billion dividend from the central bank to ramp up that spending that Modi has been doing in terms of being a bit more fiscally expansive. And the one thing that is working against India, of course, is that growing protectionism that we're seeing out of the US, that mood of it, at least, less so potentially under Harris, but some sectors will still be protected, more so under Trump. And of course, within Europe, we're also seeing a rise in protectionism to a certain extent. And again, concerns about supply chains in India. We have, again, India has a very difficult relationship with China in that regard.